Welcome to Big Picture Earnings Analysis. Today, we are looking at the customer engagement platform Braze. That's BRZE. They just reported their Q3 fiscal 26 results, and, well, the headline is pretty clear, a beat on revenue, and they hit their EPS forecast.
And not just that, they also raised their full-year guidance, which, is a huge signal of confidence moving forward. This is a really interesting look at a high-growth tech company.
Okay, let's unpack this then. Third quarter, fiscal year 2026. The top line was a definite beat.
It was a solid beat. Q3 revenue landed at $190.8 million.
And the consensus was what, somewhere around $184 million?
Yeah, $184.22 million to be precise, so it's a good margin. And that number, it represents 25.5% year-over-year growth, so the demand is still very, very strong.
Right. And then on the profit side, the metric everyone watches, non-GAAP EPS, they came in right on the money at 6 cents a share.
Exactly. So you've got this story of strong growth and, stabilizing profitability. But as I said, the real story here is what they're saying about the future.
The guidance.
The guidance. This is where it gets really interesting for anyone watching the stock. Management didn't just meet, they updated their guidance for the whole fiscal year, pushing it above what analysts were predicting.
So what does that look like in, actual numbers?
Okay, so the new revenue guidance for fiscal 26 is now in a range of $730.5 to $731.5 million. The old consensus was way down at $718 million.
So they're seeing something the market wasn't quite pricing in.
Exactly. And on the profit side, their non-GAAP EPS guidance is between 42 and 43 cents, which is right in line with the consensus.
So they're not just selling more, they're doing it efficiently enough to hold that profit line.
Right. Which is usually a great sign. But, you have to look at the stock's performance. It's been a bit of a roller coaster. It's up a little in the last few months, but it's still down over 25% for the year.
Yeah, Investing Pro still has their financial health rated as just fair performance.
It really feels like the market is waiting for proof. Like, is this growth sustainable? Is the business model fundamentally efficient now?
Well, that's the perfect transition. Let's look under the hood at the operational efficiency numbers.
This is where we see a really significant shift, the kind that, investors have been waiting for.
Let's talk about that big swing to non-GAAP profitability.
Right. So if you connect the dots, the biggest headline this quarter, operationally, is that shift from a non-GAAP loss to a non-GAAP income.
So what was the number?
Non-GAAP operating income was $5.1 million.
And just for context, where were they a year ago?
A year ago, they were looking at a non-GAAP loss of $2.2 million.
Wow. Okay, so that is a huge turnaround. That's what people mean by operating leverage kicking in.
It is. And it wasn't just on paper. You see it in the cash flow, which is arguably even more important.
They actually generated cash.
A lot of it. Free cash flow was positive $17.8 million this quarter. Compare that to last year when they were burning $14.2 million.
That's a massive reversal in just 12 months.
It is. It shows the core business is now funding itself, which is a huge milestone for any SaaS company.
But we have to be clear here. That's the non-GAAP story. Yeah. If you look at the standard accounting, the GAAP view, it's still showing losses.
Right. And we need to talk about why. The GAAP operating loss actually got a little bigger. It was $37.5 million.
So why the huge gap? How can one number be positive $5 million and the other be negative 37?
It really comes down to one big line item. Stock-based compensation, SBC. It was about $37.6 million.
So that's not cash going out the door. It's an expense for giving employees equity.
Exactly. It's a real cost to shareholders through dilution, but it's a non-cash expense. So when you back that out, you see a core business that is now profitable. That's the pivot.
That makes sense.
Yeah.
Okay, but I did spot one maybe small point of concern in the data. Gross margins.
Mm-hmm.
The contract just a little bit, right? Down about 140 basis points to 69.1%.
That's a really sharp observation. And it's important. It's not a disaster, but it suggests that to get that 25% revenue growth, they had to absorb some higher costs, maybe cloud infrastructure or something else.
So that's something to watch. The efficiency gains aren't completely frictionless just yet.
Correct. It's something you have to monitor quarter to quarter.
Okay, let's pivot from the financials to what's driving them, the customers. Are they growing the customer base?
They are. The total customer count is up to 2,528, which is a solid 14% growth year over year. Steady.
But the real story is in the big accounts, isn't it? The enterprise clients.
Oh, absolutely. Customers with over $500,000 in annual recurring revenue, or AR. That group grew by a massive 29% year over year. They're up to 303 of those now.
29%. Okay, so they're definitely succeeding in moving up market.
Without a doubt.
But
But And this is the central tension of the whole report, I think. This brings us to retention.
Right. It's great to land new big customers, but are you keeping the ones you have and getting them to spend more?
And that's the metric to watch. Dollar-based net retention, DBNR. It basically asks, are your existing customers spending more this year than last year?
So what's the verdict for Braze?
Well, the overall number stabilized at 108%, which is, it's good. It means expansion is happening. But it is down from 113% a year ago.
And what about for that big, valuable group of customers, the ones spending over $500K?
That's where the slowdown is more pronounced. Their DBNR declined to 110%, and that's down from 116% last year.
So wait, they're adding new whales at a 29% clip, which is fantastic. But the whales they already have are increasing their spending at a slower rate than before.
That is the core conflict of the quarter. Acquisition is currently outpacing expansion.
And that puts a ton of pressure on them to find a new way to drive that expansion.
It does. And that brings us directly to their big strategic answer, which is a massive push into artificial intelligence.
The CEO said AI is fundamentally rewriting the rules of customer engagement. It sounds like this is their direct response to that slowing DBNR.
I think it is 100%. They have to prove their platform can deliver so much more value that it becomes a no-brainer for these big clients to spend more. So they rolled up this whole BRZE suite.
Okay, let's break that down. There were three main pieces. First was the Braze AI operator.
Yeah, think of that as the command center. It makes the AI accessible to a normal marketer. You don't have to be a data scientist to get insights or build a campaign.
And then there's the agent console.
That's the customization layer. It lets brands build their own AI agents that fit their specific voice, their data, their rules. It's about moving from generic AI to bespoke AI.
Got it. And the last one, the one that sounds like the real heavy hitter, was the Braze AI Decisioning Studio.
This is the one that could really move the needle on that DBNR number. It's basically an autonomous agent that optimizes campaigns for you. It constantly tests, learns, and adapts in real time to hit your business goals.
So instead of a human A/B testing for weeks, the AI does it continuously.
Exactly. If they can prove this makes their customers more money, that retention number should start to climb again. It's a direct investment against that headwind.
And they back this all up with some pretty staggering performance numbers from Cyber Week.
Yeah, that was their proof of scale. They delivered over 102.5 billion messages in 7 days.
Wow.
And did it all with 100% uptime. For a huge enterprise client, that reliability is non-negotiable.
And they're not building this in a vacuum. They're integrating with OpenAI and others, right?
They are. They're leaning into the ecosystem, which is smart. They want to be the intelligent hub for customer data, not just the platform that sends the messages.
So beyond their own results, is the wider market validating their position? What are the industry analysts saying?
The validation is definitely there. Gartner named them a leader in their Magic Quadrant for the 3rd year in a row.
So that gives big potential buyers a lot of confidence.
It does. And Forrester called them a strong performer for their real-time capabilities, which is, essential for all this new AI stuff to work.
Okay, so let's look one more place for future confidence. The contracted backlog. The remaining performance obligations, or RPO.
Right. This is basically their guaranteed future revenue from contracts they've already signed.
And that number looks healthy.
Extremely healthy. Total RPO is at $891.4 million. And that's up 24% year over year, which really supports that raise guidance we talked about at the start.
So wrapping this all up, it really is a tale of two successes. You have strong revenue growth, but maybe more importantly, that huge operational pivot to positive free cash flow.
Absolutely. The financial health score might still be just fair, but the operational improvements combined with this very strategic bet on AI, it paints a picture of a company with a very clear plan.
All right, here's a final thought for you to chew on as we look ahead. Despite that phenomenal 29% growth in acquiring new large customers, that all-important net retention rate for that same group dropped from 116% to 110%. The company's betting everything on its new AI decisioning studio to fix that metric. So the question is, if we get to the end of the fiscal year and we don't see that DBNR number at least stabilizing, will the market start to wonder if the big AI investment is actually delivering the expansion value they need to justify their valuation? That's the link they have to prove in 2026.